Still on the GDP numbers, let's hear from the head of research at Chapel Hill, Durham, Mr. Tajuddin Ibrahim. Thank you very much, Mr. Ibrahim, for joining us on the program. Good morning.
Good morning, and thank you for having me.
So 0.51%, was that in line with analyst expectations? In any case, the debate in financial markets is now not so much about how quickly GDP can recover, but rather the shape of recoveries. Am I right?
Yes, you are very correct. And I think the first thing to start with is the 0.5% number that was reported by the MBS is in line with our expectation of 0.5%. And if I may talk or speak further on the numbers, what really was a major number to discuss or to talk about is the telecom sector. That number for the entire GDP will have been a lot more robust if we have had stronger numbers in terms of growth in the telecommunications sector. Nevertheless, the 0.5% is consistent with market expectations, and it speaks to further recovery of the economy post the pandemic and also post the lifting of lockdowns across the country. So it is in line with what the market was expecting.
All right, Mr. Ibrahim, interesting. But the GDP numbers show the relative flatlining of growth. Some market participants are of the view that the relative slow growth and the marginal dip in inflation means that the MPC is likely to maintain status quo at its meeting tomorrow. Is that also the position of your analysts at Chapel Hill?
Well, at Chapel Hill, Denham, what we believe is there will likely be a change in the monetary policy rate. We expect between 50 basis points to 100 basis point increase in the MPR, based on the current ongoing meeting of the MPC. And the reason is we have inflation still at over 18%. We agree that it subsided a bit in the month of April, but the reality is that it is still on the high side at above 18%, where the monetary policy rate is as low as 11.5%. So that is number one. Number two to bear in mind is that currently, as we speak, the financial market has moved ahead of monetary policy in terms of interest rate movement. Yields on the 10-year bond, for instance, are around 14%. And if you go further down the yield curve, the much longer end of the yield curve, what you find are yields that are well over 14%. So what that means is that the monetary policy rate has now become a lagging indicator in order for you to gauge the direction of interest rates. Even if you take a look at the short end of the curve, what you find is that treasury bills also have gone up in terms of the discount rates at the primary market auction. So that speaks to interest rate movement in the financial market without a necessary movement in the interest rate, based on the Monetary Policy Committee decision. So what we believe is that 50 to 100 basis point increase is possible in the current, for announcement, after the current meeting. Bear in mind that the decision to hold rate at the last meeting was not unanimous. We had some members of the committee that were asking for a rate hike. So these are our views at Chapel Hill Denham. We believe if they do not implement a rate increase tomorrow, most likely the meeting that is coming next in July, there will be a rate hike. So by about 50 basis points to 100 basis points. particularly bearing in mind the weaknesses that we are seeing in the foreign exchange market.
Now, the Nigerian stock market has already been trading negatively all of last week. How do you see investors at both the equities and fixed income markets now reading these numbers?
Okay, so equities in the first case, as you said, has been in the negative terrain, and that is largely speaking due to the repricing that we are seeing in the fixed income market, where yields are going higher. So investors really wants to tap into the higher yields in the market. So leaving equities on the back burner in that case. And what we believe, nevertheless, is that we still have valuation being cheap in the equity space. And on the back of the current GDP numbers that were published, what we believe investors should be doing in the equity space is to take a look at sectors that have demonstrated resilience, sector where we are seeing stronger growth relative to the last quarter. And I believe very strongly that investors should be taking a look at the telecom sector, the agri sector, and also, most importantly, the cement sector, where we saw a very strong double-digit growth in GDP in the first quarter of this year. So that is on equities. If we speak to fixed income, I think investors in the market are still waiting for the decision of the MPC to be announced tomorrow. Before that decision is announced, it is unlikely that the market will be aggressive in terms of how they play in the fixed income or money market. Nevertheless, the trend is more to the upwards. It is more to the upwards in terms of yields in the market, and we expect yields to go higher substantially if there's a rate hike tomorrow. But if there's no rate hike announcement, what we'll probably see is a gradual upward movement of rates, considering the low liquidity in the financial system as a whole.
All right, so the saying goes, sell in May and go away, but some pessimists are even saying now that you sell in May and stay away. We saw the highest level of volatility in the crypto market last week. Many investors were burnt and are licking their wounds right now. Do you think that the Nigerian investors will have the enthusiasm to overcome the current fatigue in the market, particularly with the slow, growth as we're seeing right now?
Well, I think what really matters is, the saying that goes like sell in May and go away. That saying made a lot of sense when foreign investors still in this market, and when they were sort of controlling the market in terms of participation. But these days we have, largely speaking, local investors, the PFAs in this case, the insurance companies, the local investors are the ones sort of driving the market as we speak. So even if you sell in May, you are going nowhere. As a local investor, you are in this country. So what really matters to me is cherry picking, a case where investors take a very careful look at sectors that present compelling growth opportunities. Equities will be on the back burner just for a while, and because there will be a peak, there will be a time that interest rates will peak, and at the moment that materializes, we'll begin to see more interest in the equities market. And if we take a look at earnings announcements, the earnings that were announced in the first quarter were good. If we see such momentum in the second quarter, chances are that before the end of June, investors' interest in equities will pick up again. Don't forget that all stocks in the market are not performing at the same rate. The performance, across the sectors is different, and that suggests to you that you will continue to see the blue chips, such as the MTN of this world, such as Dangote Cement, such as Lafarge Africa, Seplat, And, like a Nestle, for instance, you will still find those as compelling investment cases. If you also take a look at the banking sector, we believe investors should consider the likes of GT Bank, consider the likes of Zenith. You are not considering them just for cheap valuation alone. We are also considering them because of the free float, that is substantial for them, that allows you to go into those sectors and, buy stocks, that are liquid, and it also allows you, when you want to exit for whatever reason, allows you to also exit. So those are, what we have been discussing with our clients and the direction we believe they should be going in terms of equities investment for the second quarter of this year.
Yeah. Now, looking at these GDP numbers, the manufacturing sector impressively grew by 3.40% in the quarter on the review from a negative 1.51% in the fourth quarter of 2020 and, of course, 0.43% in the first quarter of 2020. What impact is this likely going to have on manufacturing stocks or stocks, manufacturing-related stocks listed in the exchange?
So the impact is positive, and what we expect is that the sector's performance, in the first quarter is an indication of a recovery from the weaknesses that we experienced in the past 2 to 3 quarters. And bear in mind that the cement sector had a very strong growth number of 11.2% in the first quarter, and that speaks to increase in the volumes of cement bags that were sold by cement manufacturers in the country, led by Dangote Cement, followed by BUA Cement, and the third being Lafarge Africa Cement. So when you find private sector investment rising, demanding more for cement, you will find a better real estate sector. You will find a stronger cement sector, and as a whole, you will find a stronger manufacturing sector. When you also find cement distribution going higher from one city to the other, what you should expect is robust earnings by the cement manufacturers. And what we believe in is that investors, if you take a look at the GDP and you want to play the market, you should play in the manufacturing space. And we strongly recommend the cement sectors, the cement stocks. In this case, the number one of them being Dangote Cement, number two being Lafarge Africa. From a valuation standpoint, we believe BUA is expensive as we speak. Nevertheless, investors that want to take a very long view as the company may consider buying into the stocks, because the Q1 GDP numbers is an indication of the earnings that will be reported in the second quarter of this year. And those earnings, to my mind, will be a lot more robust. And chances are that, some of them will consider interim dividends. It is not impossible.
All right, Mr. Tajuddin Ibrahim, thank you so much for your time on the program. Mr. Tajuddin Ibrahim is the head researcher at Chapel Hill Denham. Thank you so much.
Thank you for having me.
All right, let's look at what the market numbers are saying with Aniete. That Aniete, last week was brutal for equity investors. Perhaps this latest, GDP might offer some hope, to push the numbers higher this week.
Well, good morning, Ladi. I hope to share your optimism, but the market is still reeling from that massive and brutal week. We lost about 620 billion naira last week. And of course, when you take a look at, let's pick up from where we stopped on Friday. The markets, over the weekend, we lost nearly 3%. And that's because of the massive sell-off that's affected large and mid-cap companies across board. The Airtels of this world, the Dangotes of this world. So take a look at the impact. Although it didn't have much impact for the volume of transactions, or we had about 1.4 billion, 1.4 billion in volume, and then more than 11 billion naira in value. But then when you take a look at the sectors, banking all across board, it was in the red, but only the oil and gas sector was up because of Seplat's gain. So now to give us more details about the market, especially as we start Monday, let's join David Adorin, as a stockbroker at High Cap Securities. Thank you for joining us, Mr. David.
Yes, thank you. Good morning. Nice being with you.
Okay. So now we are starting a new week, the fourth week of May. And for the better part of the month, we've had a lot of bloodletting, more than just last week, more than 600 billion naira lost. What was the main driver for that loss? And, which is that with the MPC's meeting, what are we to expect from the market?
Okay, thank you very much. The market is feverishly awaiting the decisions of the MPC, hopefully this week. And that may chart a course for the capital market. But let me briefly touch on the comments you made regarding the decline we have witnessed in the equities market in the past few days or even weeks. That is correct. The market has actually declined. And just last week, we saw an uptick in the demand for bonds. So what happened was that there was a migration of financial assets from equities to bonds. For instance, the price of bonds appreciated last week, while that of the equities declined, indicating that investors' confidence had been on decline since the first quarter results hit the market. So apparently there has been nothing dramatic or what we call price-sensitive development capable of attracting funds into the equities segment of the market. And so we find the bond segment now firming up both at the primary and secondary market. So there is migration of financial assets, therefore, from equities to bonds. But what are the upside factors that are capable of reversing this trend? First and foremost, the crude oil price is stable. Then secondly, we also have declining inflation rates. I'm sure we're all aware of the recent figures released by Bureau of Statistics. And then thirdly, we're having a situation where COVID-19 pandemic appears to be fading away in Nigeria. So those are upside factors that can reverse the trend we are seeing. But what are the downside factors that can exacerbate the decline in the market? Number one, insecurity continues to deteriorate with undiminished intensity. Secondly, there are uncertainties anyway, just like we mentioned at the beginning, concerning the monetary policy meeting that will come up with decisions, I think tomorrow or so. That will give us an inclination as to how the market will proceed into the immediate future. Thirdly, we're also aware of the rise of interest rates in the U.S. So this has a way of migrating assets away to the advanced economies.
Okay, David.
So if we are therefore looking, are you still with me?
Yes. So, I may have to cut you there so that we can get back to the studio. So thank you for bringing us up to speed at the markets.
Okay, it's a pleasure.
Okay. So that was David Adorin, a stockbroker at High Cap Securities Limited. So, Chimi.
I guess we'll keep our fingers crossed this time. You know, Mr. Ibrahim said the sector to watch is actually the manufacturing sector. So we'll keep watching that. Thank you for the update. We'll take another quick break now. When we come back, we'll do an opening call to London. Do stay with us.